What if I told you that one of America's safest economic assumptions just collapsed quietly, expensively, and almost invisibly? For decades, the United States believed something so obvious it was never questioned. Canada would always be there. Always reliable, always friendly, always integrated into the American economy like a backup system that never fails. When problems hit, when oil markets tightened, when supply chains shook, Canada was the steady constant no one worried about. So when a trade fight erupted between the United States and Canada, most people barely noticed. It sounded harmless, symbolic, political noise. A few tariffs, a few angry statements, and then back to business as usual, but then gas prices surged. Supply chains began to strain. And something unexpected happened. China quietly stepped into a conflict it was never supposed to be part of. Welcome to its financial history, too. This is the story of how a trade war between neighbors backfired, how energy markets reacted faster than politicians, and how economic reality once again ignored slogans, intentions, and promises. To understand how this unfolded, you need to understand how deeply connected the US and Canadian economies really are. These two countries don't just trade with each other. They function like a single economic machine. Every single day, billions of dollars in goods cross the border. Cars assembled in American factories rely on parts that have crossed that border multiple times. Food, lumber, electricity, and most critically, energy flow back and forth almost without friction. Canada is not just another oil supplier to the United States. It is the largest and most reliable one. This is not oil shipped across oceans on tankers. It is oil delivered through pipelines, tailored to American refineries, optimized for American infrastructure. For decades, this relationship was treated as permanent. That belief was reinforced by trade agreements like NAFTA and later the USMCA, built on one powerful assumption: cooperation is cheaper than conflict. Integration creates efficiency, and efficiency keeps prices low. But politics has a way of testing assumptions. As inflation rose and domestic pressure increased, protectionist rhetoric returned. Politicians promised to defend local industries, punish unfair trade, and bring leverage back home. Tariffs were framed not as risk but as strength, as control. At first, the measures seemed limited: steel, aluminum, industrial inputs. Canada responded. Retaliation followed. Negotiations slowed. On the surface, it looked like just another trade dispute, the kind both countries had survived before. But beneath the surface, something had changed. Global energy markets were already fragile. Years of underinvestment had tightened supply. Geopolitical conflicts disrupted shipping routes. Refineries were running near their limits. In such an environment, even small disruptions can have oversized effects. And the trade conflict sent a signal markets could not ignore. Initially, the impact was subtle. Tariffs raised costs for maintenance equipment and refinery components. Transportation costs increased. Insurance premiums rose as uncertainty grew. None of this made headlines, but all of it added pressure. More importantly, confidence began to erode. Energy traders started pricing in risk. Refineries increased hedging. Long-term supply contracts were questioned. When uncertainty enters energy markets, prices don't wait for shortages. They move in anticipation. Canada, watching this unfold, began reassessing its own position. Relying heavily on one market suddenly looked less safe than it once had. Alternative buyers, once secondary, started to look strategic. Gasoline prices in the United States began to climb. Not because oil had disappeared, but because predictability had. Then came the moment when the problem became impossible to ignore. Prices at the pump jumped faster than expected. Trucking companies felt it. Logistics networks felt it. Consumers felt it immediately. Political leaders scrambled for explanations. How could prices rise when the United States still had oil? How could Canada, a close ally, be part of the problem? The uncomfortable answer was this: energy doesn't run on friendship. It runs on infrastructure, logistics, and trust. American refineries are designed for specific types of crude. Canadian heavy crude fits perfectly. Replacing it isn't simple. It requires adjustments, blending, and higher costs. When Canadian supply became less predictable due to trade tensions, refineries turned to other sources. Those sources were more expensive, often farther away, sometimes politically riskier. And then the story took its most unexpected turn. As Canada diversified its options, China was watching closely. Chinese energy buyers had been searching for stable, long-term supply as their own demand continued to grow. They moved decisively: long-term contracts, infrastructure investment, strategic engagement. Canada didn't cut off the United States. But it didn't wait either. China didn't need to replace America. It only needed to compete. That competition shifted global pricing. Canadian producers gained leverage. American buyers lost the advantage they had taken for granted. Global energy prices adjusted upward. And the cost flowed downstream straight to American consumers. Governments responded with familiar tools. Strategic reserves were tapped. Temporary relief measures were proposed. Blame was passed around, sometimes to oil companies, sometimes to foreign governments. But none of these addressed the core issue. The real damage wasn't supply. It was trust. Markets had learned a dangerous lesson. Even the most stable trade relationships can become political overnight. And once markets learn that, they don't forget. This pattern is not new. We saw it when semiconductor supply chains were disrupted and rerouted faster than factories could adapt. We saw it in Europe, where energy dependence turned into geopolitical vulnerability. We saw it during the pandemic, when hyper-efficient systems collapsed under stress. The sequence repeats every time. Integration creates efficiency. Political disruption breaks confidence. Markets overreact to protect themselves. Consumers pay the price. In this case, China didn't cause the problem, but it benefited from it. And that is the part policymakers often underestimate. Every trade conflict creates an opening. Someone else will step into the gap. Trade wars are often sold as precise tools, controlled, strategic, temporary. But in reality, they behave like chain reactions. Once started, they spread through energy markets, finance, logistics, and geopolitics in ways no one fully controls. The deeper lesson is uncomfortable but unavoidable. Interdependence is not weakness. It is how modern economies keep costs low. Breaking it may feel powerful, but the bill always comes due. The real danger isn't just higher gas prices, it's normalization. When disruption becomes routine, stability disappears. And when stability disappears, everything becomes more expensive permanently. So the real question isn't whether this trade war backfired. The real question is how many times the global system can absorb shocks like this before the damage stops being reversible. If this video helped you see what's really happening behind the headlines, make sure to like, subscribe, and share it with someone who still believes trade wars are simple. Because in economics, consequences are never canceled. They're only delayed.